Okay. It is quite interesting, and obviously over the course of the year, I've been going around and seeing clients and having discussions about Brexit, about the U.S. elections, and invariably over the last 6 months, I've spent more time as a political analyst than I have as an economist, as an asset allocator, what have you. And while things like Brexit and the U.S. elections are actually quite important, one of the things that I do fear has been lost in a lot of this discussion over the last few months has been what's happening in the global economy. So we talk about Brexit and we're worried about how that's going to influence policy. We talk about what Trump is going to do in terms of trade relations, etc. But what has been pushed off the front page, to be completely honest, has been the very good numbers we've been seeing in the global economy. And if you look around the world, really for the first time in a number of years, you have the four major regions of the world starting to re-accelerate in a coordinated manner. Now we all know that the Chinese story has been a difficult one for the last few years as that economy has slowed. And we have seen, and that's come through with some of the data, the Chinese economy has reaccelerated. But I think it will surprise a lot of people to see, if you look at this line, the U.S. has actually been one of the economies that has been consistently slowing for the last few years, decelerating. And what has been most consistent has been actually the European economies. But what we start to see now is you can see the Chinese economy bottoming, reaccelerating, the Japanese economy starting to reaccelerate, the U.S. economy reaccelerating, and the surprise of 2017, I think, for a lot of people, was that the Eurozone economies likewise are reaccelerating. And so you have this synchronized global recovery that's taking place, and in spite of all the political outlook, we think that this is one of the key things we want to focus on when we think about constructing our asset allocation for 2017. One of the key conclusions from this, though, I think, is this discussion of inflation. And I know a lot of people and a lot of the press has reported, Trump is coming in, he's going to come do fiscal stimulus, that's going to be very good for inflation. But if I tell you, even before Donald Trump was elected, the story of inflation was a story you should have been focusing on, and we were certainly focusing on, because it is a story of long cycle bottoming, I like to call it. And you can see in this slide here, so this is core inflation. This is X energy, this is X food, this is earnings. These are payroll earnings, what people are taking home in their paycheck in the United States. And you can see really since about late 2014, 2015, both of those numbers in the United States have started to accelerate. Now everyone says, wow, inflation in the United States is accelerating. That's not something that we usually hear about. And why is that? It's because the other part of inflation, which we know, commodity prices, have been keeping the numbers down. But you can see here, whether you're talking about oil, which we see very publicly in gas prices, etc., but also industrial metals, food prices, for the first time really in a number of years, are no longer dragging down overall inflation. They're positive year on year. Wages are starting to accelerate. Core inflation in the U.S. is starting to accelerate. And this is now coming on the back of what everyone wants to focus on, which is elections, Donald Trump. And so I would characterize the election of Donald Trump as pushing on the gas of an already accelerating and picking up inflation story in the United States. I think that is one of the key messages we'll want to talk about in the context of the global economy. So we have global cyclical recovery plus an acceleration of inflation, and that's going to be a key theme, both from an opportunity perspective, but also from a risk management perspective in portfolios going forward. Now, being in Europe, a lot of people say, yes, well, inflation, that's an issue for the United States. Europe is in deflation, will always be in deflation. We have lots of structural problems. And while technically that is true, one of the charts that we've used for several years now, recall Europe started providing stimulus a bit later than the United States, several years later. And if we match up in terms of when they both began quantitative easing, you'll see that the pattern in Europe is actually looking very similar, and the pattern in Germany is looking similar to the US. You have this long cycle bottoming of inflation, and you have the prospect as we go into late 2017, 2018, that the same type of momentum reasserts itself in Europe. So one of the key messages I want to leave with you, this inflation story, yes, it will come through in the US first, but it is not a US-only phenomenon. It's something that we should start to think about for the world as a whole. So what does that mean in terms of our base case scenarios? Again, we're still in a world where we want to have a base case. There are some risks we'll want to manage, and we'll talk about that a little bit later. But what it means is you have, for the first time in a long time, growth is going to come to 3.5%. It's driven by a recovery in the US and Japan, as well as the move out of recession in places like Brazil and Russia. So it's really two-pronged, not just developed or not just emerging. It is developed and emerging combined. And that's, I think, a key message that we have for 2017. And so the question is, how do you make money from it? Everybody says, okay, what do I do? How do I make money? And I will argue that's the wrong question to ask. It's not only how do I make money, it's how do I get paid for the risk that I'm taking? And the way I illustrate that, if you look back in 1995, if you wanted to get 7.5% return, it was very, very easy. You would call your banker, you say, I'd like a portfolio 7.5% return, and he smiles and he says, I can do that, put you all in bonds in 1995. In 2005, your banker sweats a little bit, but he says, I think I can get there. 50% in bonds, 50% in equity. And if you called him over the last 2 years, he sweated a lot because I can't put him in bonds. I got to take a lot of equity, a lot of volatility. Actually, 3 times the volatility of 1995 to get that same return. So the question is not how do I make money? The question is where are you getting paid to take the risk to generate that kind of return? And I think that really is the question. And if we look in the fixed income space, and Christel is going to spend some time on this in much more detail, even with this rally in bond yields here, you're not getting paid for this prospect that inflation continues to rise going forward. You're getting paid better, so you're less overvalued than you used to be, but you're not getting compensated enough for that. And again, the split between the US and Europe, I would argue that in Europe, if you look at the spread between German yields and US yields, yes, the ECB can try and keep things anchored, but as we've seen over the last few weeks, if the US yields keep going, it will drag up the yield curves around the world. And so one of the key messages here is, yes, you can find some safety in places, but even in the government bond market, this is a place where you're going to want to manage risk much more aggressively, and in particular interest rate risk going forward. Let's talk a little bit about a term everybody is throwing around, normalization. So everyone says, the Fed is going to normalize. What does that mean? If you look back historically, this is the real interest rate profile of US 10-year government bonds. And it's moved down. Pre-2000, it was about 3 to 4%. After the tech bubble, it went down to 2 to 3%. Immediately after 2008, it went down to 1 to 2%. And then they threw the towel in and said, look, let's push it all the way down. Let's go negative. And that's where they went to. And then when they tapered in 2013, they said, let's push it back up. The US economy slowed, and they said, that's a little bit too much. We had Brexit, we had this Brexit shock, and we're negative once again. And so from our perspective, this issue of normalization, if it works properly, we should stabilize around here, 0 real yields. So about, let's call it 2.5%, about where we are. At that rate, the US economy can continue to operate, and it won't be too problematic for ongoing growth. If you see interest rates moving sharply above that, as we did in 2013, then the risk of a much sharper US slowdown comes into play. And so that's how we look at normalization. It's less about how rapidly will the Fed move and more what happens in the US 10-year market. And that's why when we look at it, the story is one of risk management. It should stay around here, 0 real yield.
If it shoots higher than this, then that's going to be problematic. And this is why the risk management story is going to be very important. So how do we hedge against that? One of the places we think you're getting paid to protect against this risk is going to be inflation-linked bonds. As we talked about, inflation right now, core inflation is about 2.2, 2.3. The inflation-linked bond markets are actually only pricing an outlook of about 1.8 right now. And so if we're right, as things move forward, you have skewed upside as inflation rises. If we're wrong and inflation stabilizes here, you're okay. You don't lose that much money. And so on the inflation-linked side, this is a way, instead of holding government bonds, to protect yourself against this prospect of rising inflation in the years ahead. On the credit side, again, this is a place where you're being compensated fairly for the outlook that we have. But as we talked about, what you're going to see and what you're going to want to do is manage interest rate volatility much more actively. So as opposed to the last few years where you said, give me credit, give me duration, give me more as we go forward, what you're going to want to do now is not go out and seek that, but more actively manage both directions of that interest rate risk going forward. So when we look at the bond space, again, so where are you being paid? You're getting paid in inflation-linked, you're getting paid in floating rate bonds. And what you need to do is you need to spend a lot more time today managing risk on your high yield, on your emerging market, on your investment grade portfolio. So a passive approach really doesn't make sense here anymore, and you want to shift more to an active approach going forward. On the equity side, and we were talking about this earlier with some of you, U.S. equities, we're roughly speaking about 20 times earnings in U.S. equities. What does that mean? If you look back 50 years, the market has not sustained 20 times earnings for very long. So risk is actually quite high in U.S. equities from here, and so we're cautious in aggregate on the outcome for U.S. equities. But when we dip down into the market for U.S. equities, it's actually quite interesting. If we look at what we will call high volatility versus low volatility, or high risk versus low risk. So over the last year, what kind of equities did everybody like? Everybody liked dividend yield, they like cash flow, they like balance sheets. These are these safe stocks. If you look back right after the 2001-2002 crisis, when everyone got out of tech, everybody also liked safe stocks. They liked, and the premium got to such an extent that it was very, very wide. We're at about the same levels right now. You have this market where everyone said, look, I don't care what I pay. I'm going to take a dividend yield. I'm going to take safe stocks. And I don't care how much I'm getting for these cyclical stocks where the balance sheets aren't as good. I would much rather own safety. And so from that perspective, just like in 2002, 2003, we think you want to exit the safe trade, dividends, bond surrogates, and you want to be in much more cyclical trades going forward. I want to spend a little time on what I'm going to call the Trump trades. And why things like banking, why things like healthcare might or might not do very well in the future. And the story of healthcare is actually quite interesting. So if you look at healthcare stocks is one of our picks last year. We thought ROEs would stabilize, et cetera, but Hillary Clinton threw a bit of spanner in the mix. But if you look at the problems this sector has had since 2001, this used to be a sector that used to generate ROEs of almost 30%. And then generic competition came in. They dropped to about 20, 22%. Obamacare came in. They dropped to about 16%. And this is why healthcare stocks in general have had a very hard time over the last decade and a half. And so if you get a repeal or even a partial repeal of the Affordable Care Act, you have valuations relative to the S&P 500 that are near historical lows. You can see ROEs come up. And if you see ROEs come back up into that low 20s area, you can see earnings accelerate by about 10 to 25% from here. And so that's why we think the risk-reward trade in healthcare is actually quite good from here. When we look at the banking sector, I think it's a bit more complicated in the banking sector. You have a situation where Glass-Steagall was gradually weakened, and then ROEs went up to about 20%. Dodd-Frank was enacted after the crisis, ROEs came back down, sub 10%. And what people are hoping is a Dodd-Frank repeal will push ROEs up. Again, higher interest rates will be very good for some of the banks, but Dodd-Frank, imagine going back and saying, okay, trading desks come back in, prop trading comes back in, high leverage comes back into the banking sector. We think that's a fairly aggressive stance to be taking. We're happy to take the view that interest rates rise. And so if it all worked out, you could see earnings come up quite a lot in banks. But as banks have done well, really since the summer, we want to be cautious on picking our entry points in banks going forward. Let's spend a little time on what I'm going to call the global reflation trade. And we think the best global reflation trade out there right now is Japan. If you look historically, Japan has traded very well with inflation expectations in the US. And on top of that, if you look at where we are, right now we're at about 1.3 times book in Japan. Historically, anything 1.3 times book and below, your risk reward is skewed in terms of what kind of return you can expect going forward. So net, we think if you're going to play the reflation trade, Japan is the way to do it. We've added to Japan over the course of the summer, and then as well going into the Trump victory. So when we look at the equity side, again, in the US, it's actually quite expensive. We want to manage that risk by diving in. There's going to be value, it's going to be healthcare, and being selective in banks. Outside of the US, Japanese equities, and we can talk about it a little bit more in the Q&A, it's a better reflation trade, we think, than the European equities from here. And emerging market equities in absolute terms, we continue to like them, good value. But in relative terms, in particular versus the US, they've encountered some headwinds, which we can get into as well going forward. Just to wrap up, so how do we manage risk in portfolios? And this is going to be very key, we think, in 2017, especially as we get more and more interest rate volatility going forward. One of the key risks we want to manage, and I had a question earlier today, aren't people getting too excited about Trump? You know, nobody's worried anymore. Everybody buys into stimulus. The way we characterize the Trump outcome is start and stop. My colleague Patrice Gautry has coined this term, and I think this is quite right. You have an immediate fiscal benefit, and so that should be very good for growth. That should be very good for earnings. They're going to bring some money back overseas, pay some more dividends. Everyone gets excited about that. But then you have the stop component, which is, you know, whether he immediately does trade sanctions, et cetera, not really the issue. But rising fiscal deficits and public debt, you're already seeing the adjustments on the rate side. You're seeing the adjustment on the dollar side, so that means in the future, earnings will be much more challenging. And so this is the challenge, and we think this is the risk of a Trump presidency going forward. When we look at Europe, a lot of people say, yes, Europe, we understand the electoral risks, but Europe is cheap, I should buy Europe. When we look at Europe on a sector basis, Europe is not that cheap. Where's the cheapness in Europe? European banks. European banks are much cheaper than the United States, and we think they're much cheaper for very good reasons. So we're not buyers of the European reflation story as much as we are the Japanese reflation story. So how do we protect against that? We actually think that we need to rotate away from using fixed income purely as cushion within the portfolio, and that's largely because fixed income can't do what it used to do. If you have a 10% fall in markets, for example, in the DAX, you need 10-year bunds to be at minus 50, minus 70. And they're just not going to, because it would damage the banking system. So we think the alternatives universe is actually going to become a much more important part for this cushion in portfolios. And everyone says, yes, but hedge funds have done very poorly. And indeed they have. We think in general, the landscape is tilting more in favor of active management, including hedge funds. But one of the strategies that we're increasingly using are risk premium strategies. And this is a place where we're looking at the different characteristics of assets and saying, within equities, we actually don't like high dividend yield, but we do like value. And really digging in and trying to pull out the subcomponents of the asset classes that we think can generate return. And that's going to be a very important part for 2017 and beyond. So just to wrap up, so if we look at this risk management component, it's going to be focused on hedge funds and risk premia. More tactically, we are using things like gold and a short euro US dollar position to protect against the risk that we see in Europe. So I'm going to stop there, and I'm going to turn it over to Christel.
Thank you very much. I want to dwell a little bit further on fixed income, and in particular answer the question Norman already alluded to the changing role of fixed income, the changing role in your portfolios, and indeed in particular the protection from the rates that used to be there in your portfolio might not be there to the same extent going forward. But the two questions I want to answer today is, number one, should you still own fixed income assets in 2017? And number two, if you answer yes to that question, which segment should form the core part of this fixed income allocation? The answer to the first question is yes, you should still own fixed income assets in 2017. And we'll discuss why in a second. The core segments which we see as playing a crucial role in your allocation next year are the following. Number one, it's going to be credit investment grade in dollars. Not necessarily taking the risk exposure, I'm meaning dollar-denominated credit investment grade, even for portfolios in euros, even for portfolios in Swissy, whereby you might or not hedge the currency exposure. But that's the first part, that's the first layer. This is your defensive layer. Then going up in scale in terms of expected return, the second segment which we like and which we think offers value going forward is global high yield. We would really encourage you to look at the way we have been investing in high yield at UBP, which is through the use of CDS indices. Why am I mentioning that? Because you get access to a segment which is fundamentally attractive from the macro fundamentals, we'll see that, attractively valued, 7% yield, and you won't compromise on your liquidity profile if you go through CDS exposure. That's your second segment. Your third segment is subordinated debt of systemic banks. And we'll look at those three segments. As Norman said, it will be important, and we as asset managers at UBP, whether at the Global Investment Committee level, whether at our level in funds and in products, we believe that it will be indeed important. We will be able to add value by dynamically managing the allocation to those segments, meaning the geographical exposure, meaning the overall credit exposure or the interest rate exposure. But these are segments you should expect to see in your portfolios, because I think they will be the core segments, the one that offer values going forward. Now, why is that fixed income continues to play a role? Well, number one is that 2017, for all the excitement that there is, and this is really nice that we get all those themes, but will not look fundamentally different to the last 3 years. We get steady growth, that's the really good news, and in fact it's even, as Norman was saying, cyclically accelerating, all the better for expected return elsewhere also than fixed income. However, we remain in an environment of structurally low growth. That's the first point. The second aspect is volatility is here to stay. Market depth has come down across markets, and risk events abound. I mean, we just have a few at the door now. So we have the OPEC meeting in a couple of days, Italian referendums, French elections, Donald Trump actually coming in. So the volatility we've seen over the last 3 years will continue with us in 2017. And in this context, this is where fixed income assets will continue to play a key role. Why? Because they are providing a steady income in your portfolios. So whereby we can manage dynamically around the risk events, a steady income which is attractively valued will be of importance. So let's look a little bit at that 2017 story with pictures now. Volatility, you see it here at the light of the evolution of credit spreads in euro and in dollars over the last 3 years. Honestly, the themes and fears, you name them. There has been for anyone's taste a fear at some point in time, being it China, being the oil price, the Volkswagen saga, the Deutsche Bank story. And you see the reactions in the market have been large every single time. That's a function of this lower liquidity in fixed income, but elsewhere as well. And that is to stay with us going forward and next year as well. So we should be ready for this further volatility. Now, what is pretty astounding is if you look what has fundamentally changed over these 3 years where we all got so excited, so worried in February, so worried last summer, was it going to end, all in bad tears, etc., fundamentally, very little has changed. You see, that is basically the illustration from the global manufacturing sentiment. So pretty much the global economic cycle. And you see in the last 3 years, that line is flatlining, literally flatlining. The volatility that we've had in the last 3 years is a fifth of what we used to have. And that is normal to a large extent because indeed global growth has come down. So you can't have the same volatility if your actual average growth has come down. So we don't get both bad sides of the coin if you want. But really that's the message, is there hasn't been, for all the excitement, there hasn't been much changing over the last few years. And it is in this environment that you see indeed the working of fixed income assets when you look at Sharpe ratios. This is what is depicted here. What is a Sharpe ratio? Pretty easy. It's just looking at what is the average annualized return divided by your average annualized volatility. So in a sense, it's the return for the unit of risk that you take. It's not a pecking order of what we like or don't like. It's just the steadiness of an asset class. And unsurprisingly, what you find at the top of the chart is basically fixed income. In that case, euro investment grade, dollar investment grade. Now you're going to say, wait a second, but rates have been coming down for the last 3 years. And this cannot be repeated. In fact, we are most likely at the bottom and potentially rising slightly. So we can't repeat that again. And this is just polluting the number. Okay, that is absolutely true. And in fact, we don't want to count on any rates coming down further. We are also clearly, as you've heard from Norman, thinking rates have bottomed and will probably start a very slow grinding higher cycle. We remove this effect. We look at the two bars in the middle. This is income only, coupon only. There is no impact from rates coming down. And yet you see the actual Sharpe ratio, the actual return for risk that you take is still twice as high as that of the S&P over the last 3 years, although the S&P has gone up quite nicely in the last 3 years and is 4 times that of the Euro stocks. Again, not an inducing, not a recommendation or pecking order of the asset class, but just showing the steadiness of the income. And you need that in portfolios because we can't just all live with cyclical assets in a portfolio. So that's why going forward, this won't change, basically. We're still at the same juncture. Now, we were mentioning the cyclical recovery. I want to spend some time about why it is that growth will remain lower than pre-crisis. And the answer is that it is now structurally entrenched. And the way to see it is just look at the easy equation of what is actually long-term potential growth. How fast can an economy grow? Well, it can only grow as fast in the long term as its population growth plus its productivity growth. It's those two items only that will define growth. Now, let's look at the most dynamic of the developed economies structurally, which is the US. Population growth there is 0.7%. Productivity growth, and this is where the big problem lies, has been over the last 5 years 0.5%. That is extremely low on a historical basis, meaning your trend growth at the moment, the equilibrium growth, is 1.2% only. The Fed has brought it down year after year, but is still sitting at 1.9, meaning you need to get this big recovery in productivity to actually get there. I'd be more than happy to discuss that in the coming years, but for now, we're not seeing it. The reasons we don't yet know. Actually, economists are looking, the Fed is looking, they're the most well-placed to know. It's probably underinvestment, regulation, friction cost, many things, but for now, structurally, we are capped. And this is also capping this return, basically, of rising interest rates. This has had another impact, which is to bring the neutral rates down as well. So Norman was mentioning real rate. This is the sort of structural part as well. I'm looking more at the structural part of the equation. The real rates are the rates that should prevail just to stabilize an economy. Same growth, same inflation. This is what you do as a central bank. You put the rate at the neutral level. Now see where those neutral levels are. It's basically 0 for the US, -1 for Europe. And that tells you something, which is we all thought that interest rates had come down so sharply that we were hugely stimulating the economy. Well, maybe we were not stimulating that much because we just basically followed the decline in this neutral rate. So we've just accompanied what was on top was the QE, so there has been a stimulus, but maybe not as much as we thought there was. And that is the reason that inflation has taken so long to find its bottom and start going back up, basically. Now I want to look and focus on Trump, basically. So that is for the structural part, and you will have understood, I mean, pretty much, honestly, we'll have cycle again. But take the last 3 years, I think we can picture them pretty much going ahead like that in a very similar fashion. Trump is a new event, completely. So what does it change, basically, for us, and in particular on fixed income? Well, his platform is on trade protectionism, on which we don't have very much information yet, so let's leave that aside. The other avenue is basically fiscal stimulus. The estimates that we have at hand, based on what he's putting forward, is that his measures will stimulate the US economy by about 0.5 to 1% of GDP. That's the additional growth that you should get over the next, say, 12 to 18 months, roughly. So that's a good news for the US economy. It's a good news for US assets. It's one economy which will get a fiscal boost. Honestly, we haven't had that for years across the globe. So that is a positive for the US assets. It's worth a repricing. Where? Well, firstly, short-term rates. Because everything else equal, if fiscal can stimulate, the Fed will have to hike slightly faster than was planned. That's your first area of repricing. Second area of repricing, long-term rates. Because you reprice the short end, that will reprice the long end, and you get more inflation as well. Third segment you want to reprice, the dollar. And I think this is the clearest conclusion of all, in fact. Now, this repricing you have seen under your very eyes since Trump's election. We have done a serious work already in terms of repricing those variables. Now, where we stand right now, our belief is we're closer to the end of this repricing than the beginning. In other words, this is not the beginning of a trend up, straight line in rates. We have done the heavy lifting that was needed on Donald Trump's election. Why am I saying that? Well, number one is when you look at the repricing on Fed expectations, the market has added 2.5 rate hikes more until 2018. In other words, before Trump, the market was anticipating the Fed to hike 2 times until December 18. The market is now anticipating the Fed to hike 4.5 times to 4.7 times. That's a serious repricing. We get 1% max more of growth. This is worth, normally on the neutral rate, about 25 basis points. So we've gone beyond already. The second aspect is what Norman was mentioning. The dollar is the clearest case and will do a lot of the work for the interest rates, a lot of the work for the Fed. We've seen that over the last 3 years. This has been the adjustment variable. Lastly, and potentially most importantly, can we change with those Trump measures the productivity part that I showed you? We can improve it, but we can't completely turn it upside down. So maybe we go from 0.5 productivity growth to 0.7 or 8. That's a good thing. But we're not going back to pre-crisis just because Trump has been elected. So this is why we think we're closer to the end of that repricing. Now let's look at the segment I was mentioning in terms of expected return, the current yield in particular, and the numbers, some of them have changed obviously since Trump's election. You see here the 3 core segments that I've mentioned: credit investment grade in dollar, global high yield, subordinated debt of systemic banks, and you've got LIBOR-based exposure as well, as a hint for investors, for those of you who are more worried about inflation, or as a hint of what might appear in your portfolio as we manage dynamically. The point here is, this is a portfolio which is investment grade. In that 60% of your assets are investment grade. You get an expected volatility of 4%, which I think is manageable. Interest rate exposure of 3 years, which is short dated. Your expected return is cash plus 4. In dollar term, it's 5% because the investment grade yield is slightly higher. So you are indeed looking at a 5% carry roll down portfolio. This is what you enter in today in terms of yield. I think this is attractive, just thinking about it in terms of segments. We built it in the exact same way for Euro investors now, or Swiss investors. Now, obviously, you don't get the same expected return in absolute terms, but you still are looking at this cash plus 4. And this is your comparison, right? I mean, it's not the absolute we can't fix. It's the excess return that you do above cash. And cash plus 4 is what you achieve with this type of portfolio. The weights are entirely ours. Obviously, they need to reflect your risk appetite, but this is just to give an indication. So are you buying these assets expensive? This is just very simply looking at where's my yield today compared to the last 3 years. Given I'm telling you structurally we're about in the same position today as over the last 3 years, well, let's look at where you buy it. And what you see, you basically buy it at the same level. So if I'm starting from right to left, actually, the other way around, subordinated debt of systemic banks, same level as on average over the last 3 years. High yield, slightly cheaper today as over the last 3 years. Investment grade was, as we worked on the presentation, slightly more expensive. The yield was lower than your average yield over the last 3 years. Well, good news, it's gone higher. It's now 3%. So you basically are fundamentally, we like those segments because of the macro backdrop, which is supportive. You've got growth, but you remain in a low, let's say, low interest rates environment. And from a valuation perspective, on a historical basis, you buy them at very fair level. Now, in absolute, investment grade, this slide is slightly complicated. The story is a little bit more complicated. Let me try to make it easy, just to say, when you buy credit investment grade today, medium dated, 4 to 5 years, you don't want to go too long, your yield is 3%. That's a round number. In addition, as an expected return, you should get an extra percent, which is the roll down. What is it, the roll down? Very easy. Is when you have an interest rate curve, which is upward sloping, meaning a 4-year bond has a higher yield than a 3-year bond. If you buy a 4-year bond at 3%, you hold it to maturity, you make 3% on average every year. Now, if you buy a 4-year bond, and after 1 year you say, well, you know what, let me sell it and reinvest in a 4-year bond, given it pays me more, the interest rate curve is upward sloping. As you do this all the time and you keep a fixed maturity, that is worth 1% of roll down. So they take that into account. It's there on every asset class which has a steep curve and which is liquid. So basically, to cut a long story short, it's going to be your investment grade stuff that you should expect to see this roll down, and CDS, but let's leave that aside for now. Investment grade, 4% return, 4-year interest rate exposure, no default rate exposure. Why? Because you're buying investment grade. I think that's good to start as a basis in a core portfolio. Let's move to high yield, second segment. High yield you're buying today at 7% yield. The same as the average of the last 3 years. It's delivered you 7% on average over the last 3 years. And what you see is it compensates you for a default rate of 7%. Now, this is literally a Lehman-like type of scenario. This is not at all what we have in the cards. We're expecting 3 to 4% of default. So you are buying this asset class at an attractive level because you are overcompensated for the actual default risk you take. Why is that? It's because you keep a premium because of the volatility that we've seen over the last few years. And you know what? In many presentations over the years, I've kept being asked, what do we do when spreads are at zero? And my answer has always been, but you know what? For what I've seen over the last few years, every 3 months, we've got a risk event which brings us just back up where we were. And ultimately, the spreads stay at the same level. And I think we keep going that way. And this is good. This is the dream for me as a fixed income investor, in a sense. The carry will stay at the same level. Now, I think 7% as an asset class, honestly, we're going to have to be hard-pressed to find things that will deliver 7% on a year-in, year-out basis. This is why we think it will feature in the fixed income portfolios. Last segment is the subordinated debt of systemic banks. Now, what you see, I want you to just start focusing on the green line, which is the core tier 1 ratios of the banks. This is the mirror image to the default rates on the high yield segment. This is to say, as these core tier 1 ratios of banks go up and up and up, your risk as a bond investors goes down and down and down in a sense. It's nothing else but your default risk, your risk on coupon, your risk on triggering. Now don't get me wrong, this must be done name by name and securities by securities, but from a top-down basis, the systemic banks have this soundness through the tier 1 ratio. Now you're going to tell me, yeah, but for instance, the additional tier 1, they've been pretty volatile animals. They have, because they are deeply subordinated, because they are the cousins of the equities, and they should be treated as such. The question you have to ask yourself, and that's the way we think about it, is to say, am I ready to own half an equity in terms of risk that pays me 6% in coupon? This is the question you ask. And I think the answer is yes, in my mind, with what I see in terms of fundamentals, because I trust they will be paying those coupons year in, year out. And ultimately, this is what the market thinks too. It's been volatile, but when you compare the performance in green of additional tier 1 with the performance of bank stocks, what you see on the right side is, on average, you have made 5.5% performance every year over the last 3 years, your coupon, whereby stocks have been down 10% on average every year. Now, I think the stocks have turned the corner as well, which is all the better for additional tier 1. If equity stocks start doing well, we probably will actually get some spread compression there. I don't want to bet on that, but it could be that they've turned the corner. But you see this differentiation has indeed been made in the market as well. It's not for all portfolios, it is racy, but you are compensated for the risk you take. Those banks have been utilitized in your own. They've gone from hedge funds to utilities. This is where I'll stop, and I'll leave you with those conclusions, those 3 segments we like: credit, investment grade, high yield, subordinated bank debt, which are enough to build portfolios, even staying investment grade, which can deliver cash plus 4%. And this is the basis we'll start working on with looking into 2017. And we are now both at your disposal to take questions on these or other subjects. Thank you.